I always recommend people or retail investors to stay away from commodity stocks altogether.
How are you looking at the IT sector now?
So we still are in a zone where we think that the worst is not over when it comes to the global economy. I overanalyze the stock. That is a problem.
This is one thing I think which a lot of very enthusiastic analysts do.
Yeah.
They overanalyze things for 3 months, 4 months, and they find out things which they don't even should. So that thing happens. Thank you so much, Sagar, for doing this. To begin with, I'd start with a very interesting question which a lot of investors would like to know. What is more important for you, business or valuations?
Wow. I think business,
Okay.
because we've seen that a lot of companies with good businesses and good growth, they tend to stick around at high valuations for prolonged durations. That's number one. So even when investors fixate a lot on valuations, they think कि valuation बहुत ज़्यादा है, we shouldn't invest at
Right.
such high valuations. Valuations either stick around or they even re-rate
Right.
at a lot of times. So as long as companies are great, they're showing good growth, I think valuations stick around.
Right.
Number two, I think investors are also very forgiving for good businesses when it comes to valuations.
Right.
So even if there are mishaps, if the company is not performing for a quarter or two, or for even a year or two, there's a strategy change, something happens. Valuations don't tend to correct so much for good
Right.
businesses,
Right.
but for bad businesses, they will correct massively.
Right.
So prime importance always
Right.
on business.
So you spoke about re-rating. I think a lot of people would like to know what exactly this concept of re-rating is and how it works in public markets.
Um, so at a very fundamental level, the valuation is what you pay for a stock, right? How much you're willing to pay. And not how much you are willing to pay, how much the market is collectively willing to pay for a certain stock. Re-rating simply is collectively the market being able to or being willing to pay a higher price. There's 2-3 things that happen here. I think how we look at it is that whenever there is a company which is undiscovered, and it gets discovered, more people are willing to buy it, valuations shoot up. Number two, it is showing extremely good growth, great business performance. People are willing to stick around with it. People want that stock. Demand goes up, valuations go up. So re-rating is any process where people are willing to pay a higher price.
So I can technically say that a PE of 10, maybe 5 years down the line for a company is justified. But then today, the same company, if it has been doing tremendously well or might be doing well starting today, a PE of 20 is also fair. If that is how it is. All right. That makes a lot of sense. Based on this, what all themes do you think are something that will do well in the future for the Indian markets?
So for the Indian markets, there's one theme which is very popular at this point in time, which is the entire government theme. So all the fiscal effort, all the fiscal push, spending aggressively, I think that one theme is playing out extremely well. From the perspective of defense companies, from the perspective of manufacturing, from the perspective of infra, all of those aspects. So we're being a little sector agnostic here. We're saying that, hey, as a theme, government spending is great. Within government, the second theme that's playing out is the transformation in PSUs. So all those companies that have been running in a very redundant manner in the past, or have been just pure lazy, have been turning around in terms of how they're operating. There's a lot of professionalism coming in. Pay grades are getting better. Scale is tech is being utilized in a better way. So I think a lot of change on that front as well.
How much importance is this operational efficiency plays out for companies, or how much important is management for companies, as you pointed out, since it is changing for a lot of PSUs. So how important is this in the broader set of things?
So let's look at it this way, right? Like private sector, public sector banks, for example. For a long time, these guys were sitting on very high NPAs. They were inefficient when it came to deploying capital. Access to capital was not the problem. Deploying the capital was a problem, and deploying it efficiently was the problem. Suddenly, that has started seeing a lot of change. So there is aggression in terms of lending. There is aggression in terms of lending at the right places as well. And that overall aggression comes from professionally managed people or just revamping how they work and function as a team. And that is reflecting in financials now. So over the last year, if you see, profits for all the PSBs have doubled or tripled, right? And stocks have also gone off the roof. So direct correlation.
So there has been a phase where the PSUs, didn't perform well for a very long time period, and they started doing well recently. How important is this entire, gimmick of sectoral rotation, where we see some sectors doing well at some point in time, and then later on, it suddenly shifts to some other sector. How can we identify that as retail investors or individual investors?
Right. So I think 2-3 things to look at, and not only government, right? I'm talking about all sectors. So there are some sectors which are cyclical.
Right.
So everybody needs to keep a strong track of like where volumes are headed, pricing is headed, what the cycle is, and these are primarily commodity stocks. So cement, metals, all of these companies. As retail investors, I don't think there is enough bandwidth for them to constantly keep a check on which cycle is moving where. Zinc ka price is moving because something happened in Brazil or in China or whatever. It's very difficult for a retail investor to keep track of that. So I always recommend people or retail investors to stay away from commodity stocks altogether. Because if you look at commodity stocks over a period of 3 or 5 years, they won't make money if you stay invested.
Right. So you have to catch the bottom and
But if you keep doing that, there is like potential for making immense amounts of money. Right. So as retail investors, strictly avoid cyclicals. But you can get into fairly predictable sectors which are more structural in nature and which hence are a lot more steady state. There are some sectors which may give you very obvious calls. Like for example, investing in IT, say 1 year back or 1.5 years back, would not make sense because you know the global economy is going down the drain. And most of their revenue for IT sector, 60-70% comes from the US, 20% from Europe. So it doesn't make sense investing in those. So I think very basic logical correlation between what's happening in the world with a particular sector is enough to make these decisions.
How are you looking at the IT sector now, given that we spoke about it?
We are still avoiding it.
Okay.
So we still are in a zone where we think that the worst is not over when it comes to the global economy. There's a lot which is uncertain. That is also showing in IT companies' order books. It is also showing in their revenue growth. So we're yet not comfortable getting placed in the IT sector.
So can I say, for example, estimate my entry points and exit points in the IT sector based on how the US economy is functioning or how the Fed is, increasing, decreasing the interest rates based on the macros of other countries? Can I predict how the IT sector might perform in India?
More or less. That's usually been the case. We for a few years back we thought that correlation will slightly get disconnected because a lot of the services that these companies were offering were more digital in nature, which has a more structural growth story compared to the cyclical nature earlier. So, for example, like every auto company, irrespective of what the market is or what the economy is doing, has to invest in infotainment systems, has to invest in EVs, has to invest in better powertrain, batteries, whatever. So any service provider which does this is performing well, right? So we've made a differentiation between or distinction between IT companies where we're saying that any provider which is heavy towards banking or non-discretionary spend is something which is discretionary spend is avoidable, and anything that is transformative for an industry, like the whole auto example. That's more non-discretionary, right? Companies don't have the option of saying, hey, I'm not going to invest in this particular space. So any company servicing that industry becomes like a better buy. So you've seen engineering companies, engineering service companies doing really well. Scient, KPIT, Tata Elxsi, LTTS, which are fairly more stable. So while I say we wouldn't invest in IT, we've got positions in engineering services.
Though they're at higher valuations right now.
I think that's justified, right? I mean, they are exhibiting growth. They have a long-term story. They have a structural play.
Makes sense. In terms of IT itself, there's a lot of frenzy going around, AI, and it might impact IT and the kind of revenues IT companies make in India. What is your take on this?
I don't think it's that big an impact when it comes to IT services companies and how they operate, right? Like given the revenue streams that they have, I don't think it's
okay. All right. So on the very similar lines, like I would like to talk about Rupeeting and the way you have approached Rupeeting and the kind of portfolios that you have made. One of the themes that you follow at Rupeeting is, around monopolies and how monopoly businesses might tend to do well. So what's your take on that? How do you look at monopoly companies? Don't you find that these companies are maybe overvalued to some extent? How do you see it?
So with monopolies, I think the first thing that comes to people's mind is that if it's a monopoly, it is a large company.
Right.
What we do is while we take a balanced approach. There are some companies that we have which are fairly large, like an ITC, where it's discovered, it's a large company, and what you're saying is probably right. However, we also try to balance it out by finding companies which are large but in small industries. So we've, for example, invested in the largest granite sink manufacturer in.
So there might be a 3,000, 4,000 crore company,
Yeah.
but very large in their space in terms
Yeah.
of market.
So they've got a 50% plus market share in whatever they're doing, but the space itself is very
Very
small.
small, right?
So these companies we tend to find are fairly cheaper in terms of valuations.
Right.
They are much better.
Right.
They have potential for diversification. They are exploring new spaces or even innovating or transforming their current space.
So based on the themes that are working right now, ESG has been the talk of the town. Not today, but at least a couple of years back.
Yeah.
How do you think ESG is doing in India or abroad or globally per se?
Yeah, so there's a lot of frenzy around ESG.
Right?
But what happens when it comes to investing is we've seen that investors or say investment managers who are excessively focused on the ESG bit miss out on the investing.
Right.
So they miss out on a lot of the themes that they're supposed to that they could make money in, but they don't because ESG comes into play. And that's not that big a problem until the whole ESG concept is misunderstood.
Right.
So I'll give you an example here, and that also talks about how we differentiate compared to other ESG funds. Is where, for example, fluorine. Right. Fluorine, harmful chemical, bad for the environment. Emissions affect both global warming as well as ozone depletion. So people put a blanket ban on fluorine companies if they're an ESG fund, that they won't invest at all there. However, if you try to study the history or get some context in terms of how it operates, you'll realize that fluorine, for example, in the 1980s was discovered that it's harmful. Right? CFCs were used at that time; they got banned. From there, the world moved to HCFCs. Then the world moved to HFCs. And now from HFCs, the world is moving to HFOs. Right? And this progression with HFOs, for example, the ozone depletion is zero potential. And with emissions or global warming potential, that is a fraction of what used to be earlier. So if you look at it from the perspective of change or delta from what was to what is, there's a massive difference in how much harm it's causing to the environment. Right? And that is reducing massively. So we find such things acceptable when it comes to investing, and we are okay with that because there is a change towards the positive
side.
Right? So it may be harmful, yes, but are they moving in the right direction? Yes.
Okay.
So we won't stay away from investing in, say, a Gujarat Fluoro or an SRF or a Naveen Fluoro.
Is there a perfect definition to where an ESG fund can invest, or this is a vague definition which people perceive it themselves and it is subject to how they are interpreting ESG? How does that work?
Yeah, I think it is highly subjective. There are it depends on the fund manager, it depends on the consumers, and it's highly fungible. A lot of ESG funds we've seen, what they do is a very simple approach of picking up ESG ratings by somebody who does ESG ratings and just allocating money according to where the ratings are. However, every rating agency operates differently. So if you as a fund manager are not conscious about what the differences are, what a rating agency is looking at, it's pointless even doing that. So we've got a very differentiated approach again. We look at governance factors, we look at employee benefits, we look at these environmental factors. So I think a balanced approach is what works best, but it seldom happens.
So one thing I think, since you have been into this particular space for 7-8 years now, are there any methods or ways how you go about your business and pick up stocks?
Yeah. So we realized there is a framework when we actually sat down to jot it, and I mean, we've been following it forever, but formalized only recently, and we figured that we follow a certain pattern. One is we look for, at a very start level, we look for stories. These have to be long-term stories. There has to be a narrative around what you're investing in. And it's important for you to understand that narrative because then you research around it and you get more knowledge and context around it. So primarily, first focus is on whether there is a narrative or not, and understanding that narrative. Number two, we come to earnings or financials. So whatever the narrative is, are numbers reflecting that narrative in a positive way or not? And because what you do is some people just jump into financials directly. But if you don't understand the narrative, what are you making sense of when it comes to the financials, right? So next thing is to look at the financials, look at earnings growth, look at whether there is potential in terms of what the narrative is. Is it matching with financial performance or not? The third thing we jump onto after that is valuations. Obviously, everything that we buy has to have a right price, and that right price is subjective. We need to find that the price is right. What we also seek at a lot of times, our ideal combination is a combination of earnings growth, which is high, and valuation re-rating.
Okay.
So if we are in a place where earnings growth is high but re-rating potential is low, we'd not give it as much allocation
Okay.
as
All right.
high earnings growth, high valuation re-rating. That's the third one. And the fourth one is a trigger.
Right.
So at a lot of times, fundamentally good stocks, if there is no trigger, will not move.
Okay.
They'll keep trading sideways. There'll be
How
a period
ITC
of
worked for like 2 years back.
for years, right?
Right.
It was a great stock.
Right.
Every investment book that you read will always throw
Always,
out.
right.
Fundamentally, it is a great stock,
Right.
but it won't move.
Right.
Reliance has not moved for so long before Jio,
Right.
So all of these stocks, they need triggers, and
Right.
if you're not cognizant of a trigger, if you're not looking for that trigger and not investing with the trigger, then you're sitting on a dud investment for a very long time. And that is an opportunity cost. You would have rather made money somewhere else than
wait
stick
here.
around over
Right.
here.
So Sagar, you spoke about looking at the financials, like after the narration, after the business story, you look at the numbers, the financials. Which of the three financial statements is the most important for you? Is it the balance sheet? Is it the income statement or the cash flow statement?
Cash flow statement for
Always.
sure. Always.
Why is that the case?
Because companies that look beautiful on the income statement may not really on the cash flow statement. Cash flow statements are a derivation when you financially model stuff, right? Your assumptions go into the income statement, your assumptions go into the balance sheet, your cash flow combines the two of them. So cash flow is a true depiction of both the other statements. And without the cash flow statement, I think it's at least our analysis is always incomplete.
Do you have any example or something from your past experience where reading at the cash flow statement gave you more insights than what you could have gained from maybe reading an income statement or a balance sheet?
No, a lot of companies where the margins are extremely high, for example, the EBITDA margins are high, but what you do realize at the end of it is that the cash conversion is really poor. So cash conversion becomes poor when you look at the operating cash flow divided by the EBITDA.
Right.
And if that is low, then you're not doing a great job. There's a lot of companies which keep investing heavily into capex.
Right.
There are two ways of looking at that as well, right? There are some companies which people are very forgiving when it comes to investing in growth. Aarti Industries was one such till last year, where capex was very heavy. They're supremely aggressive in terms of expansion. But the markets were okay with that. FCF generation was hardly anything, but the multiple was great because the company was growing commensurately.
So since we are speaking about stocks, you spoke about Aarti Industries, you spoke about a couple of them previously. What was the first stock that you invested in? When did you invest in it? And what was the story or reason behind investing in it?
This was, I think, long back on my first job, maybe 10 years, 12 years ago. Invested in Mahindra and Mahindra.
Oh, all right.
And that was a period when the XUV 500 had just come.
Okay, all right. The first model.
Yeah.
Okay.
So that was where Mahindra was riding that SUV wave, which was the pioneer in SUVs, which are now so common in India. And that trend had started or kicked off through XUV.
Okay.
So I think that was the first stock, first investment I had made. And that was a good 50-60% at that point in time. But the problem is when you realize that the amount you had invested at that time and the amount you made, 50-60%, it hardly matters now. Right?
Absolute numbers,
doesn't. At that time it was a big deal.
Right.
But now I look at it and I'm like, I wasted that 50% opportunity by not investing money.
Right. So did you look at some financials back then, or it was just the story and how things played around?
No, I just entered the finance field, so I did a full analysis. I overanalyzed the stock. That is a problem.
This is one thing I think which a lot of very enthusiastic analysts do. They overanalyze things for 3 months, 4 months, and they find out things which they don't even should. So that thing happens. So on this very same line, what one piece of advice do you think any upcoming analyst who's being there into fundamental research, what he should do, what his approach should be?
Understand business.
Okay.
Forget financials for a while. Understand business. Because you get deep into, you've been taught so much, right? In your masters, your CFA, you're like constantly looking at statements. But later, when you start understanding business, you realize a lot of the connections between what you're seeing in terms of numbers and what it actually means in terms of business. For the longest time, I think even I was on that side where you've been told that negative working capital is great. But how is it good? Right? You understand only when you think of it from a business perspective that you're getting money first and then giving it to suppliers. So in terms of growth, you don't really need capital when it's negative working capital. You don't have to pick up like a working capital facility. You don't
Right.
have to pick up loans. You don't have to fund your growth.
Right.
Your growth funds more growth.
Right.
So I think if you understand business and how it works, it becomes a lot easier to know what to look at when it comes to financials. Because a lot of the analysts even we hire and that we see in the market come up and they have this template of ratios that they want to look at.
Right.
But everything that they look at lacks context.
Got it.
So it doesn't make sense. You can't look at like looking at cash flows as well, for example.
Right.
Some companies which are guaranteed good in terms of business, are very ethical, are in industries where cash flows don't matter. For example, IT industry,
Right.
cash flows are always going to be healthy, unless there are outliers there as
Right.
well. But you don't need to look at cash flow statements that heavily into IT
Right.
companies, and we don't. Then.
So I think for everyone who's not into finance and they think that it's a hardcore job, it isn't. So all you need to know is how to understand businesses first. This is one piece of advice that is something that we can take from this. And once you do that, that is when the numbers will start making sense to you automatically. So Sagar, how has your journey been, right, from picking the first stock, which was Mahindra and Mahindra, to starting Rupeeting and then creating your small cases and listing them down, and then onboarding users to actually go and buy your investment ideas, your investment thesis?
Yeah. So no, quite diversified, I would say, the journey. Started with retail advisory, HNI advisory.
Right.
That's
Okay.
where I started first. There was
Okay.
this company called Dalal Street Investment Journal,
Okay.
which was very iconic back in the day in the 70s and 80s and
Okay.
90s.
Right.
But it vanished after.
Okay.
But they had a small bit of advisory
Right.
bit that I joined in. Moved on to institutional broking right after. So I was in antique stock broking for a
Right.
couple of years, Motilal Oswal for 3 years. Got bored of stockbroking. It's a constant rut. So you kind of like get over it at some point. The energy sort of slows you
Right.
down.
Right.
Got into asset management right after because
Okay.
realized that at the end of it, the gratification that is there in earning money and making money grow, that's not in facilitating transactions
Right.
through broking.
Okay.
So shifted to Daiwa Asset Management, which was a great opportunity. Spent a couple of years there.
Okay.
And realized that
Is it India based?
no, it's Japan's second largest fund.
Okay. All right.
So they had a sizable India portion,
Okay.
which I was managing
Alright.
with a team.
Got it.
And I think that's where I found my spot in terms of knowing what I'm good at, what is making me money, and
What do you
is
want to do
yeah.
for the next 20
So
years?
I
of
think
your
that ikigai moment happened
Right.
with Daiwa.
Perfect.
So that resulted in a place where I was like, asset management is the thing. And if that's the future, I'd rather own my company, build a company,
Right.
and take a lot of the things that I learned as working in a foreign institutional
Right.
investor down to the Indian
Got it.
industry.
Got it.
So that's
Makes
how
sense.
Rupeeting.
And standing today, where do you see the entire Indian markets, the entire country doing in terms of generating income, generating GDP? What is your take on that?
Yeah. So a lot being spoken about the India narrative, right? I think it's all the hype is real.
Okay.
We are in a place where demographically itself we are in a sort of better place
Yes,
compared
right.
to where the world is. And over the next 5 to 10 years, I think India will keep outperforming
Right.
in terms of GDP growth.
So does it make sense for people, in the age group of about 20 to 30 to, invest more into equities and get part of the Indian story? Or do you think other asset classes make equal sense for them?
Equities for sure. Like I've been a big fan of equities ever
Right.
since. I've never till date invested anything other than equities. No, but if you're 20, 30, it does make sense, right? Because you've got so much of a long time horizon.
Right.
And you're in a place where this sort of a moment doesn't really happen for every generation, right? Where you're in a place where the entire economy is
Right.
growing the fastest in the world.
Right.
The markets are for sure going to follow.
Right.
And you're bound to make money over the
Right.
next 10, 15 years
Right.
if you stay invested.
Right. So equity is the go-to class. In that part as well, do you think we should be more focused towards small cap, mid cap, or large cap? How is your thought process around that?
We've been fans of mid caps and small caps to a larger extent, and that's
You might have
because
seen a great run in the past 1 year, 2 years.
yeah, for sure. It's been a good year for us
Right.
that way. No, mid caps, small caps, because also large caps are sort of fairly discovered.
Right.
They are, mid caps have become large caps in a lot of cases, right? And the number of opportunities that exist to make disproportionately large returns are more in mid caps and small caps versus large caps.
Because of the undiscoverability.
Sorry,
because they are not discovered.
Because not discovered, or just plainly because of scaling up,
Okay.
potential for growth, the amount of headspace they have to grow,
Right.
right? The amount of room they have to grow. For a large cap, it could be limited
Right.
to the extent of how much the economy grows or whatever, but not for a lot of mid caps and small caps.
Okay. So, for people who are just starting out to invest, can they go about selecting individual stocks themselves, or they should rely on a small case or a mutual fund? How do you think?
For vested interests, I would say Smallcase is the way to go.
Right.
But no, I think individual stock picking also works.
Okay.
Till the time, I mean, I've seen a lot of people, including some in my family, which have not used too much of finance knowledge or whatever. They just picked up like 30 years back or 20 years back. They picked up Bajaj Auto. They picked up a Z before it became disastrous. And they've sat in those stocks for a really long time, and they've made a good amount of money doing that.
So, did they discover like the certificates in their cupboards, or
no, they've dematerialized their holdings.
All right.
So,
Right.
Yeah.
That makes a lot of sense. On the very same lines, one last question that I would like you to highlight is, what has been your approach towards making the small cases a repeating? How do you think about it? How do you rebalance it? How do you pick stocks? How do you phase out any stock? How does the entire process work?
Yeah. So I think at the core of what our philosophy is finding that confluence, as I said, of earnings growth and valuation re-rating. I think when you combine these two, you get like real good returns, and that is what we chase at a lot of times. However, at a portfolio level, you have to balance things out.
Okay.
You're not always going to find these stocks. All these stories are not always going to play out. Markets are going to be different at different times. Sometimes you move from growth to value. Sometimes you move from value to something else. So I think constant change is something that we keep doing. So a couple of things that while this stands as our ultimate sort of philosophy or hunt, the other thing that we are always principally following is that we'll never remain constant.
Okay.
So our investing style will always change.
Okay.
Our investing decisions will always change. The criteria and framework will always keep changing depending on the market.
You'll never marry a stock.
No.
Okay.
We'll never be a slave to to our own philosophy.
Okay.
We'll be a slave to the markets, and that's how we'll make money.
Okay.
And I think that approach has worked fairly well so far. So even the transformation, the constitution change, we move from large caps, we move to mid caps, we move to small caps, depending on how the markets are. I think that's how we've been able to maintain and generate that alpha that we have. At the end of it, and the third thing we'd always focus on is good corporate governance. I think as a conscious decision, we've always stayed away from any sort of bad governance, one red flag, and we are out. Because it's the people's money that we're managing at the end of the day. So the amount of risk I would take with my own money is going to be very different compared to the amount of risk I will take with somebody else's money. So I may be okay investing personally into stocks which are sketchy at the moment but have a potential to improve, or which are riskier or whatever. Because I can control the amount of allocation, but not with.
So in terms of your individual portfolio versus, say for example, do you prefer picking up in your individual portfolio versus how many stocks you think are ideal for a portfolio?
The number of stocks?
Yeah.
So I think 14 to 15 is what seems optimum from a mathematical standpoint, purely from a mathematical standpoint, because the amount of diversification you achieve at 14 or 15 is optimal in terms of risk reduction as well. Beyond that, every incremental stock you add, the amount of diversification is more than the risk reduction. So I think we don't go beyond 14, 15, either in the small cases or in my personal investments as well. So small cases are between 10 to 15, similar for me.
Similar for your individual portfolio.
Not more than 15 stocks.
That makes a lot of sense. I think there will be a lot of insights that all of us can get from this particular podcast. We came to know how exactly the thought process of a fund manager actually works while they create their own portfolio or while they create their small cases as well. So thank you so much, Sagar, for giving us time to record this. I'm pretty sure everybody is going to enjoy it.
Thank you so much.